Welcome to the Grow Your Business and Grow Your Wealth podcast with Gary Helt. Gary is an expert in helping business owners put together a plan that will provide a better future for their businesses, themselves, and their families. On the podcast, Gary interviews other professionals who share his vision, and together they share secrets and strategies any business owner can use to build a better financial foundation for your business and your life.
Hey, welcome back to the podcast. This week, my guest is Chris Belchamber, and he is an investment strategist, wealth manager, author, and founder of CB Investment Management with over 40 years of experience in global finance. He was a mathematics graduate from the University of Oxford. Chris began his career in London, rose to managing director of proprietary trading, at JPMorgan Chase, and later built his own firm focusing on helping investors grow and protect their wealth through disciplined and low-risk strategies. Welcome, Chris.
Thank you very much, Gary. Looking forward to it.
Definitely. So, Chris, you have 4 decades of working in the investment world. What made you decide that, hey, I got my degree in mathematics to then switch over to investing, and kind of give us that background?
Yeah, well, it didn't come immediately. I guess I didn't know what I wanted to do, so I tried 2 things which didn't work out. One was computer programming. I was good at it, but I don't think it was valued at that time. And actuarial trainee, which is grueling in terms of the exams and the length and what have you. And also I got disillusioned with the pension planning because I was working for a pension consultancy for a while, and I just decided I didn't really want to be in that profession. And so, but through that, I learned about investing, and finally I found that blood was flowing through my veins again. And it was an exciting time in London because it was Big Bang and all the international firms took over. The London firms had been a very insular sort of country-specific business beforehand. And so I was fully a part of that transition. So once I started getting on the investment track in the early 80s, I loved it.
Yeah. What about it keeps you going and really makes you want to keep doing that?
I love puzzles, and this is
Uh-huh.
one hell of a puzzle, and I think it just suits me. And I shouldn't say when I was young, when I was young. I'm very much someone who's interested in sports and math, as you mentioned. And it's strange, like the investment is really kind of puts those together. I mean, you've got to shoot the right amount at the right time. It just seemed natural, and I just took to it. I just loved it from the get-go. Yeah.
So, because you have been doing this for, 4 decades now, what changes have you seen from the way things were to kind of, how they are now?
Wow, it's dramatic. Yeah, I mean, I think the speed of markets is just completely transformed. That's one thing. The techniques have completely changed, partly related to the speed. We used to sit around in committee meetings and decide what we're going to do. And
Mhm.
as I mentioned in my book, really, if you want to be one of the most successful investors of all time, you have to have a system. There isn't time to consult, and also, people's subjective opinions are not as effective as what we can do with computers. Really dramatic changes, and even in the last few years, I mean, options trading is 5 times what it was 4 years ago. I mean, it's just massive. Very, very dramatic changes. And that means that what you do, how you do it, has to change to not just technically, but the whole behavior of the market is really changing all the time.
Yeah. Now, you talk about protecting wealth before growing wealth. Can you explain that and what you mean by that?
Yeah, that is the thing that I think most people just don't understand. And it came out of the book. What really defines your long-term return is your compounded return. And it's a mathematical equivalent. But people are always looking at that 3 month period or compared to that 1 year period. So, it's not doesn't make any sense. And they don't look at long enough time horizons. And what you find out, and what all the most successful investors found out, it's described in my book, um, was that you cannot be compounding. So if you're doing anything that violates compounding, you're suboptimal in some way and potentially dangerously so. So, that's really, why the kind of the low risk road to high returns is it's really unbeatable. But very few people adopt it for a whole range of reasons.
Can you give us a couple reasons why?
Yeah, I mean, people just don't do the original preparation for I'm going to be an investor. Hey, we can open an account, off we go. You know,
Right.
what are we doing? Oh, we got a return. What's that return? Is that good, bad? I don't know. You need a lot more than just a return. So it's because you can start very easily without preparing properly. Most people do. Um, but all of the most successful investors realize that drawdowns will kill your long-term return. It's the simple math that people can sort of realize. Like if you lose 10%, you've got to get 20%, make 20% to get it back, but then you're even, and you lost that time. So you've got to make more than 20%. And if you lose 50%, you've got to get 100% return to get it back. And, people think everybody knows that, but they don't. And in fact, just recently, I just sent out a note this week where the number one financial advisor in America, so self-proclaimed, um, basically came out with some analysis on X Twitter, which violated compound interest in his analysis and came to a conclusion which I believe was dangerous. So that's how endemic this is. I mean, people can't imagine that investment advice is unsound, but it is, and quite much more so than people realize, even from, what appears to be the most successful people in the business. So if you want to get into that, I mean, that note was out this week. It's on most channels.
Yeah. Um, so on the business owner side of things, many times, business owners work really hard in their businesses to build their business and try to build their wealth. But many times, the business owners are great at what they do, great tacticians, but they don't have focus on growing their wealth and what that looks like. How do you talk with business owners? How do you help them be able to move beyond that and really be able to help them start building that wealth strategy?
Um, yeah, I think the way to do it is to explain all these things, but give them a very simple, um, not time-consuming approach so that they stay in control and they know what success is and what it isn't, and they can find out in 5 seconds. And that's the great thing about compounding, is that you can make it very mathematical. There are 4 criteria, they have a priority to them, and you can set it up and you can go click, click, click. Where am I now? Where's my account on these 4 criteria? And you know whether you're compounding successfully and efficiently in seconds. So although it's complicated to get there, you can see how you're doing immediately, which means you're in control, you have accountability, and you have visibility. That's on that side. On the wealth side, I mean, I think there are a lot of advantages from tax-wise, you would know more than I do, from running a business. So, I think there's a lot to do on that side. I won't go into that because you know more about it than I do. Um, and so, I think it's a great opportunity. So it doesn't have to be time consuming, but you do have to be in charge and know what it is you're doing and how to look at it quickly and effectively. Because I don't think that many people will give you those parameters and that clarity and transparency. So that's what I would say to them on the investment side.
No, no, so, with the business owners, lots of times, they want to leave the money in the business,
Right.
because, they look at it, it's like, oh, well, I may need this. And obviously, yeah, you may, but, if you're not putting that money to work for you, then it's just kind of sitting there and collecting dust, and it's not compounding like you're talking about. How do you get them to change that mindset, to start doing something with that?
Well, the thing to do there is to differentiate between your banking business and your savings and investment business. And so I have something called the ultimate savings account because you don't get very good liquidity management from banks, the returns on what they have,
Right.
the
Right.
access to your capital, all of, there are multiple problems. But you can link, the best discount broker in the world with your bank. And once a month, you have two opportunities to do a transfer. So you have the liquidity you need in your bank account, but you're doing the best possible savings in Interactive Brokers, which are number one worldwide, according to Barron's, which is owned by Wall Street Journal. And that is a fantastic arrangement. Then people can know that they're getting a great deal. I mean, for example, very few people invest in CLOs, but you can do AAA CLOs with 125 basis points over the Fed funds rate. That's a higher rating than the Treasury, which is like AA. And so, there are all kinds of things and flexibility that you can do. So I think managing your liquidity as well as your assets is something that you can probably improve on.
Yeah, yeah. I think sometimes it's, many times with our clients, and I'm sure you see this lots of times, where I'm going to say we're talking them off the cliff and what they're doing. Um, but we have to help them build this plan out. And this is, why I preach lots of times about, picking the right team and then letting, that team do for you, as compared to, kind of having each one of your professional team members work in a silo. Because if we're not all talking, that we're not really doing the best thing for the client, not helping them
Absolutely.
reach their plan.
Absolutely. I think there's a problem with silos right across financial services because very often people are very good at this thing, but they don't understand the consequences over here and over there. And if they did, they'd be doing this differently and it'd be a bit more effective overall. Yeah, that is a common problem. So
Right.
that's why I became a wealth manager rather than investor, because I'm constantly coming across that problem. Yeah, I agree.
Yeah. Um, do you see do you see this, and if you do, how do you help overcome it with the clients, where lots of times they're I'm gonna say they're reacting to emotion and fear and things, as we're doing this interview right now, obviously, there's the crisis that's going on with Iran and US and everything, and a lot of people are reacting, out of fear right now. How do you help your clients overcome that?
Um, the way I do it. I mean, I've never had a panic phone call from a client, ever, because basically what I do is I define drawdown as my minimizing drawdown as my number one criteria, because that maximizes compounding. So right from the get-go, they know that when the markets or the account value is going down, I'm working very hard and fast, make sure we minimize that drawdown. The other thing is I use options. And so with options, when you buy an option, you know the maximum you can lose right at the outset, and you have an asymmetric upside. So that has contained drawdown too. So my clients experience something like less than half the volatility of the S&P 500. But it doesn't damage the returns. So I don't have that problem. And it comes down to understanding how to use compounding and using the right tools. And not many people do that. This is the problem with passive. Passive, you just buy and it'll be all right in the end, kind of thing. You can make a lot of money doing that in a rampant bull market. But if you remember 2000, 2008 and certain other times, you can lose a whole lot of money fast too. And thankfully the market has bounced back, but that's not guaranteed, and it might take a long time. So compounding metric, which very few people adopt on options, I would say.
Right. Right. You've mentioned a couple times about your book. So you wrote Invest Like the Best. What inspired you to write the book, and what's it about?
What inspired me was that I have incomplete conversations. I mean, it is, these things are complicated, and there's a certain amount of experience and book reading and, whatnot and research. So you never really finish a conversation properly. And I've had so many of them. So I thought, just write the book and it's all there. They don't need to read it, but you can say, I have read it if you want to look at it in any degree. There it is, the whole thing. So that was the major reason for doing that. There was a secondary question as well. Sorry, I may have forgotten that.
So it was just what inspired you to write the book? Was that it?
Yeah, and get people to realize. I mean, that the behavioral part. I mean, like the first quote before the first page is from Warren Buffett's mentor. And, he basically says the biggest problem most investors have is with themselves.
Mm-hmm.
So you have to, if you're going to be one of the most successful investors of all time, it's not because you're throwing risk around, is because you're humble. And however passionately strong your conviction is, you can be wrong. And there's so many behaviors that get in people's ways. And I think that's the biggest problem. It's not the mathematics of the markets, or well, sometimes it is. But I think the biggest problem, and we're starting, is how do you react? What happens when, oh my gosh, I've lost 3% in a day? What's going on? If you don't have a framework and a mindset about what you're doing and why and how you're going to minimize that, yeah, you're going to panic, but you're going to be panicking because you haven't properly thought out what you're doing and why. And you don't like that 3% loss. Nobody does, but you don't really have a game plan, and you've only just discovered it. And that's why you panicked. So yeah, there are a lot of things. If you do your preparation, if you won't have the panic. You say, okay, we've already thought about that. That's taken care of. Don't like losses, but this is contained and we're fine. And I think people know that when they can see the whole structure of what you're doing.
Right. In investing, What's one of the investing myths that you wish that you could dispel for everybody?
Um, I think that, the, I, I think that people need, um, to be sovereign. It's their money, and they need to get informed consent. Just because you have a professional doesn't mean that you're getting, best interest advice. Um, and it may be, and this is the issue, the issue with fiduciary against best interest. Fiduciary is ultimately an intention. I am intend to do the right thing for you. But if people don't understand what they're giving advice on properly, just like the compounding or so many other things, they don't know that they're not actually delivering best interest. So best interest is something that, um, you can define more clearly. You know the client, you know what they need. It's more precise, and it's not dependent on the knowledge of the investment advisor. So, I think that's very possible, and I think we've lost sight of informed consent. I think people are taking lifetime decisions here, and um, that can be meaningful if you're not risk managed. If you're not managing drawdown, we've seen you can lose 50% of the stock market can go down 50%. I mean, that is, if you're anywhere near retirement, that is a life-changing moment. And you need to have someone who is making sure that doesn't happen. I think we've all become a little bit happy because we've been in this extraordinary bull market for so long,
Yeah.
which is breaking all records. We've literally never seen where we are today before. That I think people have got a bit lazy, a little bit overconfident, and so I think those are the things that concern me. And I think the at the end of the day, the only person who can really do the self-protection and the best interest is yourself. So I hope that people have a source where they can check that out properly,
Right.
because it's very important.
So, Chris, we covered a lot of good stuff here in a quick period of time. What if I not asked you wish I had?
Um, no, I think you did a great job. There's so many things. I went through all your questions, and I think we've covered most of the points very well. I like the way that you approached this whole podcast. Very professional and
Thank you.
very well planned. It helped me prepare as well. So no, I think we did a pretty good job
Great.
of covering all the things.
So, Chris, if people want to reach out to you, they want to talk to you because they like what they've heard, A, where can they find your book? And B, how can they reach out to you?
Well, yeah, we've just started a Substack page this week, and it's Best Interest Wealth Management, BIWM at substack.com. So it's a really simple site. I've got two websites, chris-belchamber.com and cbinvestmentmanagement.com. So you can find me. I'm on Twitter, I'm on LinkedIn. It's not hard to find me.
Right. Chris, I really appreciate your time today, and I've enjoyed our conversation.
Thank you so much, Gary.
Great. Hey, this week our guest was Chris Belchamber, and he is investment strategist, wealth manager, author, and founder of CB Investment Management. And I'll see you guys next week.